for this session. We are very pleased to be hosting this webinar with our partner Making Finance Work for Africa. In today's webinar, we look at why our interest rate in housing finance so high in Africa by first looking at the determinants of high interest rates and then looking at the measures that we can reduce the interest rate cost of housing across the continent. We are very pleased to have with us today Dr. Michael Fuchs, who has recently authored for the Center for Affordable Housing Finance in Africa, the research paper lowering the high interest rate cost of housing finance in Africa, which he will present us today. Michael Fuchs is currently working as a consultant largely to the World Bank and other donors on financial sector development in Africa and East Africa. Until June 2013, he was advisor and acting sector manager in the finance and private sector department of the World Bank Africa region. Since 2002, Michael has worked extensively on financial sector development in Africa, leading financial sector assessments in 8 countries and for the group of countries in the East African community, as well as policy reform and technical assistance operation, including in Kenya and Nigeria. Prior to the World Bank, Michael was working for the Danish Central Bank and the Danish Ministry of Finance. He holds a PhD and a master's degree from the University of Copenhagen and a bachelor's degree from the University of York. We are also pleased to have as a discussant Mr. Mfundo Mabaso, Manager of Business Development at First National Bank International in South Africa. He will be sharing with us his experience in working in countries with high mortgage interest rate environment. Just before we get into the main subject for today's discussion, I just want to mention a few housekeeping items. Today's webinar is scheduled to last 1 hour. To ensure the highest quality of experience, all participants will be muted. But during the Michael's presentation, you can still submit via the chat or the Q&A box your questions, and Michael will then answer them after his presentation. At the end of the presentation, please don't forget to fill out the survey that will appear automatically. I will now give a brief overview of CAHF strategic partnership with Making Finance Work for Africa, and we'll then listen to Michael's presentation. So we have the Center for Affordable Housing Finance in Africa has, with Making Finance Work for Africa, a shared interest in deepening the understanding of the housing finance market in Africa. Our objective is to explore innovation in housing development and finance, and to support housing finance market development through activities such as working group, case studies and knowledge brief, and webinars such as this one. I will now turn to Michael Fuchs, and we look forward to hearing from you, Michael. After.
I seem not to be able to share my screen. Thank you. I hope everyone can see the slide. I'm going to talk about this. I hope you can all see the slide now. I'm going to talk about this very comprehensive topic, a very large, broad topic, and I've tried to divide it up into 4 different perspectives, if you like. And I'm going to address each of these perspectives from the perspective what is the issue we're actually trying to address, and then I'm going to talk about some of the remedies that could be applied to each of them. I've looked at the determinants of high interest rates from the perspective of high policy interest rates. Another issue coming up is high credit risk premiums, high maturity premiums, and limited use of collateral. So these are the 4 categories of issues that I'm going to be addressing within this short presentation today. And let me go directly into it. The first issue, which certainly is pervasive in Africa, are high policy interest rates. Mostly they reflect very shallow financial markets, difficulties in actually managing liquidity and in the financial system, even at the very short end, and as a consequence also volatile risk-free government borrowing rates, i.e. the rates which are set by the government have a tendency, because the markets are rather shallow, to be volatile. Part of the reason for this, or the main reason for this, is that governments have very high borrowing requirements, and you refer to this as fiscal dominance, over-reliance on one or another export commodity is one source of that. Once commodity prices fell, in recent years when commodity prices fell, fiscal revenues fell, and governments had to borrow more in local markets. Even in those countries, though, which didn't suffer from commodity price changes, the reliance on borrowing has still been prevalent in Africa. For example, in countries like Kenya, which had very large infrastructure and other investment ambitions. So one of the issues here is how can the government actually how can a government be a lesser player in the local markets and therefore contribute to greater stability, placing greater reliance on private sector funding. The second, well, as a result of this, or as a symptom of this, you also see that markets are not contributing much in the way of the banking system doesn't contribute much in the way of credit to the private sector. This is more prevalent in some countries than in others, but the general gist of this is that countries are not, the banking system, the financial systems are shallow, and maybe that's part of the result of this high investment in government securities, which relates again to the fiscal dominance issue. The second channel, or the second determinant of high interest rates, then are high credit risk premiums. The financial systems are quite small, and they're unable to benefit from economies of scale because of their size. And in this context, they're very high overhead costs, high operational costs, and this is best illustrated for you here. You see a decomposition of interest rate spreads across a number of countries in Africa, and you see the largest components of the spreads in the financial system are overhead costs and profits to some extent. So these systems are not very competitive, or they're very costly. They're unable to contain their costs because they require very specialized manpower, and there's competition in that market is weak. So you have a large number in many systems, the dominance of large banks, and as the government is borrowing a lot, it's far too easy to invest in government securities, and thereby the actual impetus to innovate, to invest in looking into things like whether should they banks lend more to the private sector, in particular in this case to housing, that is reduced due to this rather uncompetitive system. And you can see this here in the high interest rate spreads that exist in Africa when you compare them to other countries in the OECD, for example, getting much higher cost base for the financial system, and thereby this is passed on in the form of cost to anyone who's borrowing from a bank, including those who might want a mortgage. The third, then I just wanted to emphasize before I go to the third that the cost of spreads is particularly high for mortgage loans also because the mortgage market, the cost of equity is very high. That's to say, the risk weighting applied to mortgage loans is higher than it needs to be, really. And partly that reflects the lack of ability to recognize the value of collateral in that lending. The credit risk is considered high because of weak information systems and weak enforcement environment. And as I said, operational costs are high also for the mortgage business. And the funding costs are high in the sense that banks don't have long-term funding. So they're limited in the amount of maturity transformation they will undertake on their balance sheets. I'll come back to that issue. The third channel I'm looking at is impacting high interest rates are the high maturity premiums. there's a mismatch between long-term borrowing needs and the available short-term funds, and the domestic markets are illiquid, and it's difficult to get hold of longer-term funding. And the government bond market doesn't really provide a good benchmark on which borrowing in the private sector can take place. It's not that deep, and as I said, even on the short end, it's pretty unstable. And institutional investors aren't really engaged in the mortgage market. One point to make here is that the high maturity premiums are important, but on the other hand, one wants to be careful before saying that the interest paid on mortgages is determined by really by their maturity. So it's important that some maturity is provided to mortgage borrowers, because it's not the absolute level of interest rates which is actually so important for the cost of mortgages. If you look at it more carefully, it's actually the maturity of the borrowing. So it's making available funds with sufficient maturity that determines the actual cost to the borrower on a monthly basis. I'll come back to these issues shortly. The fourth channel I want to talk about then is the limited use of collateral, and this is kind of fundamental, I think, to the cost of housing finance. The operating environments are very difficult for mortgage lenders, and they vary even across regions within a country. The time and cost it takes to register collateral or the value of a property, and then to the conveyance of a title in that property, are really very detrimental to the ability to use housing as collateral. And then when it comes to enforcing, when there's a default or there's need to take recourse in realizing collateral value because a borrower defaults, it takes time. It's also costly. So there's a general lack of familiarity, and the markets are rather untested in the resale of collateral. This is kind of fundamental to the whole of the mortgage market, and it doesn't work very well in most countries in Africa. So then I'm going to go now and talk about some of the things that could be done to address some of the topics I just mentioned very, very briefly here. The first one obviously would be to strengthen macroeconomic management and reduce government borrowing. That's a very tall order, and it lies rather far away from the agenda of reducing interest rate costs in housing, but it's very important to that, as a broader background for that. And as I mentioned already, the domestic debt markets don't work very well, and there are ways of improving the function of domestic debt markets and increasing the availability of benchmark issues, for example, in the debt markets could help, and does help normally to deepen those markets. Again, this is not something that happens overnight. It takes time. Probably the most important thing, I think, actually, is the one about reducing government borrowing. And therefore, governments have tried to borrow abroad, and you've seen that going on actually in recent years quite a lot. Euro market borrowing has increased quite a bit again. But in the short term, they look like one way of avoiding the crowding out issue. In the longer term, it's likely to come back and haunt the government, because once it's borrowed abroad, it has to bear foreign exchange risk on that borrowing. So it will have to borrow more later. But as a short-term fix, it has been tried in recent years. I'm not sure that so successfully. Then there have been a number of countries which have said that the borrowing costs and the spreads I just showed you are just too high, and we need to intervene in that and do something about it. So Kenya and Zambia are countries where interest rate caps have been imposed. I think common to both Zambia and Kenya was a sharp drop in the growth of credit to the private sector. So they didn't actually have the desired impact on giving borrowers better access to bank credit. Rather, the opposite happened, because banks found other ways of either restricting the borrowing the lending they were doing, or by imposing fees, which they did to a large extent on borrowers in Zambia, where they have discontinued these caps, and the discussion is very much ongoing in Kenya. Another way of reducing the high policy interest rates has been through subsidies. These have been generally very difficult to administer on a selective basis. There could be a case for subsidies, but they have to be very smart subsidies, and they probably need to address, they need to be designed so they address the first years of a borrower, the borrowing for a mortgage, for example, when the cost is very high, and if it's in terms of nominal terms, where the burden on the borrower will be greatest. And there have been cases where this has been done. I think in many African countries, the problem with this is that once you institute subsidies, borrowers think they don't really need to repay on their loans because someone else is paying for them, and the other party can bear that burden better than they can. So there's a moral hazard question here. Really. Coming to the second of the areas I spoke about before, about credit risk premiums, and we saw that the very high spreads in the banking system. There are ways of reducing those spreads, and they perhaps lie an extension of what would be regarded as mortgage finance. But one of the big problems in the Africa context is the lack of competition there is in the banking system. And this does go really back to the regulators as much as to the banks. I think the regulators bear a good deal of responsibility for this, because there's been very little sanctioning of banks once they meet issues in their loan portfolios. Rather, the attitude of the regulator in many countries has been a forbearance and allowing this to carry on, because they don't really want to create a politically embarrassing circumstance for themselves. So there's a lot to be done there. Another area where there's much more could be done is on sharing credit information. This is something which, by which you get to a poor borrower, or the knowledge of the individuals who don't actually live up to their commitments to financial institutions, becomes more shared among them, and of course allows much better credit risk management. There are efforts in most countries to try and do something about this. They are, I think, in a kind of evolving state and not fully developed yet in most countries in Africa. Finally, deposit insurance is one way of strengthening competition by providing a more level playing field between large banks and small banks, because small banks generally don't have the trust of small depositors, because they're small and they're not known. The danger here, of course, is that once you establish a deposit insurance scheme, you may also establish some moral hazard may again come into the financial system, because the small banks benefit from something they don't necessarily feel responsible for, and they feel that the large banks bear the burden of the deposit insurance coverage, and therefore it doesn't necessarily benefit the system. So it has to be only undertaken where you're confident the issues I related to before about supervision of banks are addressed at the same time. The third area was lowering maturity premiums. This is important in making longer-term funding available to the banks. And one area where this has happened and is happening in many countries in Africa, and I'll slightly diverge here, is in the use of mortgage liquidity facilities. This started in Egypt and it's undertaken in Tanzania, West Africa, Nigeria. So this is actually something which is happening. The liquidity facilities are kind of a centralized bond issuer, which the banks can access to offload the maturity risk they have in their mortgage lending. So as long as what the banks do is to provide the mortgages as collateral on a recourse basis, so that if there is a defaulting borrower among the mortgage borrower, the banks have to replace that mortgage with a performing mortgage. The only disadvantage in this is if we're still impacted, the cost of borrowing for the mortgagee is still impacted by the spread that the bank passes on, and as I said, the spreads are very high in the system. But what it does do here is, and this is the important part of it, it allows the borrower to take a mortgage of a maturity equivalent to, of a much longer maturity than would otherwise be available to the borrower. And as the main relief provided by financing at all, the mortgage is closely related to the maturity of the mortgage. This is really very important relief to borrowers, mortgage borrowers. So this instrument, which has started to work in certain countries in Africa, I think there's a lot more prospect here for making housing finance more affordable. And this is probably something we should be seeing more of, I hope, in the near future. There are other ways of reducing the maturity premiums, but they are way more sophisticated. And one of those is to use covered bonds. The covered bond market is more efficient, more effective. It reduces those spreads I spoke about, but it depends on a much more well-developed institutional environment, because it's there. That's not you don't replace mortgages one with another. So as you do with a liquidity facility, but you have to actually have to make this more efficient. You have to have a very good recourse system as far as the a defaulting mortgagee is concerned. There has to be a very effective way of dealing with that risk there is in the system, i.e. of foreclosing on a mortgage and actually repossessing property, which doesn't really exist in countries in Africa as yet. Then, of course, coming back again to the long-term funding issue, what is the benchmark for that funding, which liquidity facility, for example, could undertake? And again, we come back to the issue of establishing a yield curve for government risk as being a basis for whatever long-term funding can be established. Then another issue which is prevalent or could have an important impact on lowering maturity premiums is the size of pension fund asset investment. And this is from Latin America, you see, but the general gist of the story here is that the more the pension funds have invested, the lower the mortgage interest rate has become. Of course, making more institutional demand available is important if there are to be issues, for example, as I was saying about a mortgage facility, who's going to buy these, and if that market is going to be run efficient, then the more the impact of having more institutional investors will be important. And finally, the fourth set of recommendations refers to leveraging utilization of collateral value. And these are things which I have touched upon before, but are really fundamental here. So the strengthening property and collateral registration, and foreclosure mechanisms and credit information sharing, which I had before in the slide before. These are very significant impact on the whole mortgage market, but they're not things that are going to happen quickly. And then another way of perhaps leveraging collateral value better is, instead of insisting that you because of the malfunction of the property registration system, instead of actually handing over the value of handing over the property and lending against a property, the lender could provide installment credits to those who occupy that property. It's rather like a leasing arrangement. I think this has been tried, and the disadvantage here has been that those leasing the property don't regard it as their own, which it isn't until the lease is complete, so to speak, until the installments are all paid. And that seems to give rise to less, they don't therefore look after the properties quite as well, and has given rise to issues relating to the maintenance of property value. Partial credit guarantees might also be something worth considering, there are partial credit guarantees in some countries in Africa which work very well. They haven't been that prevalent in the mortgage space, but there are SME finance. They've been used quite a lot. The bank thereby reduces its exposure. The guarantee takes perhaps 50% of the bank's exposure, and the bank is therefore doesn't take as much risk, and therefore it should increase the scope for mortgage lending. These partial credit guarantees are quite complicated, and much depends on how they're actually designed as to whether banks find them attractive. It also is such, I think, that banks are not familiar with them, so much technical assistance also has to be given to banks to understand how this instrument works. But that is certainly one way of increasing perhaps appetite for this market while the institutional reforms mentioned under point A here take place. Another venue or avenue to increasing mortgage funding has been through pension savings. So a certain portion of the pension savings that individuals have could be used on providing them with a home, so to speak. They can borrow against their pension savings so as to be able to fund their home. This has been tried in South Africa quite a bit, I think, and it's something that perhaps could be pursued elsewhere. As it says here, one of the issues here may be again to repossess homes when there is a problem on paying on the mortgage, and the kind of exposure that the pension funds and the trustees of a pension fund may not welcome very much is to having recourse to an asset such as a house, which is not kind of the usual way they'd want to see their investment want to see in their investment portfolios. In fact, many pension funds have had difficulties, whether in real estate, usually commercial real estate, in managing their risk in this kind of space before, or it's well known in some African countries. So this is not a free lunch, but it's certainly something one could try. And then there have been a number of other ways of addressing affordability, one of which is adjustable interest rates, which I'll come back to, but I think adjustable interest rates are okay. They introduce a new kind of liquidity risk, of course, for the borrower. So they transfer uncertainty to the borrower, and the mortgage borrower may not be aware of what kind of risk they're taking. So this is a long discussion. I think in most cases, mortgage borrowers like to know that this is what they're going to be paying month by month, rather than being exposed to that kind of risk. But more to the point, has been borrowing in foreign currency, and that has been tried. And there are institutions in Africa who do intermediate foreign currency denominated mortgage loans, in Ghana, for example. And the difficulty there is knowing exactly what's going to happen to the foreign exchange rate, of course. And the Ghanaian arrangement is very much functioning so that it only provides that kind of exposure to those who can manage their foreign exchange risk. So it's those with foreign exchange earnings. And so it's rather a limited market, but it's something which is working quite well, I think. Index-linked borrowing has also been tried in Ghana, for example, but it's also been tried more broadly. And I think the problem there, the problem with index-linked borrowing is the index and how to define the index. In stable inflation times, countries with relatively stable inflation experience as well worked okay. But in periods where the inflation is higher and the inflation index for mortgage, well, for the exposure to the mortgage is not quite the same as the inflation, broader inflation in society. The inflation CPI, for example, is not is not matched by what the wage inflation is in the country, you get problems with, even if the cost of the mortgage was linked to the consumer price index, the cost can increase quite sizably if the wage inflation is not the same as with the consumer price index. So you get inconsistencies in the data, in the indices which are being used to track cost, and that obviously in high inflation experiences leads to stress, and actually it's been quite troublesome. This doesn't seem to work so easily in countries like the ones we're talking about here. So just to conclude on this, I think that mortgage design is very important, and it can to the affordability of mortgage finance. And I think one of the lessons is to keep it relatively simple. And I'm referring, for example, to experiences with adjustable interest rate mortgages and index-linked mortgages, because I think they're not easy for all parties to handle. And there's plenty of evidence this is not just an African problem. Fixed rate mortgages do provide that comfort. Then there's a known repayment burden, and a gradually falling repayment in real terms is likely to happen. So going back again to the idea of a subsidy, if at any stage you're using fixed rate mortgage, it should be targeted at the first years of the mortgage and not targeted for the whole of the mortgage period. And then I think the other thing I'd like to say, and there's been a lot of discussion in many African countries on borrowers not being able to pay more than single-digit interest rates, for example. That discussion is, I think, the data seem to suggest that discussion is actually off track. What really means a lot for borrowers is what the maturity of the mortgage is, because the time periods, the longer the length of the mortgage determines the cash flow for the borrower. And so we really need to try and find extended terms for borrowers, and then you'll find that the actual cost of the mortgage is manageable, and it's not the level of the interest rate that matters so much. Finally, of course, this raises a lot of questions about how you educate borrowers and whether they're well informed about what they are actually engaging in, and the consumer protection aspect certainly needs to be more well developed than it is in most countries in Africa. And there's a huge educational and technical assistance type of effort has to be done in supporting the mortgage market and in making sure that those who receive mortgages receive affordable mortgages. Thank you very much.
Thank you very much, Michael, for this presentation. We will now move to the discussion part of this webinar. Mfundo, I will now turn to you. Can you talk a little bit about FNB experience working on countries in Africa with high interest rates and how it's impacting your capacity to grow your mortgage portfolio? No. Mfundo, I don't know if you can hear me and if you are connected. Can you unmute yourself? In the meantime, what we can do, Michael, is that we can start the Q&A. We received several questions from the participants. I will go through them and leave you the mic. And we have a question from Kesia asking about what else could be done in the absence of immediate incentive for banks in terms of collecting data, but because the role of information is critical and dependent on bank participation. Banks are busy growing their businesses, and so data often is their priority. So what else could be done to address this in absence of immediate incentives? We also have a question from Mohamed Gay. Asking that, do you think that rental housing could enjoy lower credit risk premium and lower interest rates? And there is no need to foreclose, but just need to replace the tenant. and the lengthy and costly foreclosure process. So a question about the opportunity of rental housing to lower credit risk. We also have a question from Pamela Lamoro, asking what role, if any, does the provision of some sort of mortgage insurance guarantee program in the country play in supporting more affordable housing finance?
So I didn't hear that.
The last question from Pamela Lamoro is about what role, if any, does the provision of some sort of mortgage insurance guarantee program in the country could play in supporting more affordable housing finance? I would suggest we start with these first three questions and then perhaps go back to Mfundo and take some more questions.
Yeah, I'm not sure quite what data the first question was referring to. Was it clearer to you, Olivier?
Yes, I'll go back to the question. Yes, it's about the role of information, right? And CAHF was asking what can be done to address this.
Yeah, I think this is a very, very fast evolving, very fast changing space in the financial sector, because with the kind of arrival of kind of big data type efforts, which relate, of course, mostly today to mobile financial services rather than the ones we're talking about here, the scope for addressing these kind of markets is changing very rapidly. So there are ways in which you can manage the credit risk now much more on basis of what kind of much more detailed and information base than you have had at your fingertips up to now. I haven't seen this actually apply to these markets, but I guess there's another issue here is whether some of this can become public good rather than just a private good. That's the real issue here. That's why credit information sharing has been quite difficult, because it assumes the market participants understand that by sharing information that they will gain as a collective. They may not each gain or think they may not each gain individually. And I think that's the main hurdle to be crossed, even when we're talking about the big data revolution we're seeing in these years. There seems to be the market for rental in Africa seems very weak indeed, at least in the formal market space. There may be a kind of informal rental going on quite a bit, but it's a market which obviously would benefit a lot from further development. There's a lot of background noise just now, so yeah, okay. And of course, it would be easier to shift tenants out than it is to foreclose. Well, I'm not so sure it's so much easier to shift tenants out than to foreclose on a mortgage, but that's I guess that's a practical issue one has to resolve. But I guess there are issues here as to the whole of the legal and framework for the rental market in many countries is not that strong, and therefore it may not be so easy as the question was implying. I think there is much more scope for doing more in the way of guarantees, mortgage guarantees, as I think I was saying in the presentation as well. I think this has not been tried that much, and there is scope for thinking about how to introduce more guarantee mechanism. In fact, is a way of replacing collateral, because the guarantees, in fact, that should be seen as collateral for a bank loan. Again, it's a short-term way of dealing with a problem, and until that collateral becomes more readily available as a security for a mortgage. And as we're talking about mortgages, I guess we really need to focus on how best to make that the house, or the value of the house, the collateral, because this is such a good, it's just, for a bank, it's the best kind of collateral they can imagine if it was working properly. So while I think the guarantee is a good idea, still the real problem is to address the for registration, conveyance, foreclosure issues there are on real estate, which is a fundamental issue in mortgage finance.
Okay, thank you very much. I think Mfundo is back online. So Mfundo, if you want to comment a bit, and then we'll take more questions after your intervention. Thank you.
Certainly. Can you hear me clearly?
Very well. We can hear you very well.
Okay, perfect. Yeah, no, I think having listened to some of the presentation, some of the issues that were raised from a banking point of view, and particularly F&B having played in the rest of Africa and particularly in South Africa, I can definitely relate and speak to a few. So I was really excited when you started talking about mortgage guarantees. So it worked exceptionally well for us when we were playing in the lower end of the market to try and make mortgages more affordable. So it afforded us the opportunity to actually extend credit to the full value of the required amount, so at 100% of the loan to value, as well as although we couldn't extend fixed interest rate over a long period of time, we could at least offer the fixed interest rate over a 5-year period, which gave the customers in the lower end of the market more comfort and a security around knowing how much they were going to be expected to pay for that period of time at least. So amongst the things that we've also found, and so I beg your pardon, let me just go back to mortgage guarantees. So we then took that model, which worked very well in South Africa, and wanted to apply it in the rest of the countries that we play in. So specifically, we've rolled it out in Tanzania as well as Zambia, which we have found has actually given us a little bit more leeway as well. In terms of the long-term funding, well, affordable funding, that has been one of the issues that we have found ourselves in as well as a bank, particularly in Zambia, when liquidity issues from a broad scale, the country was facing liquidity issues. We found that we needed to find a lot more institutions that were willing to advance long-term facilities to us so that we could on-lend those funds to our clients. So we worked with some DFIs, and we've been approaching a couple of pension funds as well. So I think predominantly the content of your presentation I could really resonate with, and we've been grappling with the same kind of issues from a practical point of view on how do we actually take the issues that we're facing and actually, make them workable so that we can extend credit at a more affordable rate to our customers. So I think it was really, really beneficial. There are a couple of things that I'm going to come back in greater detail just to find out what are your suggestions and about. But yeah, all in all, really beneficial presentation. Thank you.
Thank you very much, Fundo. Thank you very much. Very useful. Michael, we received a few more questions. I'm going to read them to you and to get your comments. So we received a question from Megan Sager, who was asking what has contributed to the success of Africa's mortgage program, such as Determinants company. And we received another question from Tisha Rust on mortgage design. What is the impact of creating demand for micro mortgages? We are now promoting housing delivery for houses below $20,000, $100,000, and go as low as $10,500. Would such a mortgage and its design change the condition or elevate some over others? Michael,
you want me to answer that? Yes, I can answer. Yeah, that's fine. Ghana Home Loans, I believe, is the success of this company is the one I mentioned before, because I believe that the Ghana Home Loans is largely doing lending in foreign currency, and thereby able to bring interest rates down for those borrowers who have incomes or other assets which are denominated in those currencies. So it's a very special niche of the market it's serving rather than the broader market. And I think it's functioning well, it's well managed, and it's a success. But its scope is going to be limited by the client base, which has such assets. And so I'm afraid I'm more it has a more limited applicability than I would like to see, and certainly you couldn't, for example, do that for the kind of micro borrowers the second question was addressing, because they wouldn't be able to cope with the risk associated with foreign currency borrowing. Foreign currency borrowing was something which the experience is very in the European context is quite clear, where borrowers borrowed for mortgage borrowers borrowed in countries like Hungary and Poland decided before the financial crisis they would borrow in Swiss francs because it was going to be cheaper for them, and in these cases there's been a very heavy lessons has been learned by those borrowers and by that process. So one has to be very careful. I think the micro mortgages perhaps relates back to the question which was asked before about how we can improve data, because if data must be an important part of that. So information sharing about those borrowers who might be taking micro loans would make it much easier for micro mortgage markets to expand more rapidly. Again, it's very dependent on the credit risk those micro institutions are taking and whether they're able to manage that risk. I guess in a sense that goes back to a question as to whether there's any common bond among the borrowers for micro mortgages, and maybe that wasn't the nature of the question, was not part of the question here, but that would reduce the credit risk if there was some felt responsibility among the borrowers for repaying the mortgage. That again would substitute for some of the missing knowledge about exactly what kind of risk is being taken by the lender. And I guess the same would apply as applies to other mortgages about the security of that lending, the security for that lending, and whether you can actually foreclose on micro loans of that kind or not.
Okay, thank you very much, Michael. It's very clear. I think we have more questions. I invite the participant to send us now to Q&A. We received an additional question from Marlene Aymans. She is asking if there is any information where the housing finance provided a gateway assets toward mortgage. Can you answer that, Michael, please?
What is meant by incremental housing finance?
I think she means the incremental in terms of incremental construction of houses. So housing finance product to fund incremental housing building.
Yeah, I think that much of mortgage finance in Africa was incremental finance, if that's what it meant by that question. Yes, that is the usual way that when you don't have access to a mortgage, you fund the building of your house, so to speak, as time goes on. The advantage of that is that you can take many small incremental loans, and if you're actually building the house at the same time, the actual cost of funding you'll find is much smaller than if you take a larger loan for a longer period. Maybe that's self-evident, but that reduces the cost of the mortgage in that sense. But it means that you're kind of in a situation where you're living in half a house, and you suddenly, when it comes to an apartment building, you can't build half an apartment. So it limits the scope very much of what kind of dwelling you can afford. If it's not the ideal way of going about solving the problem, I think.
Thank you. We received another question from Steve Timpona asking if do you view well-developed housing cooperative in Africa that can bring larger pools of pre-qualified middle-class applicants to the mortgage market as a more viable avenue for attracting more affordable investments in the sector?
So I didn't quite get that. Sorry, you have to repeat that.
Sure, no problem. Do you view well-developed housing cooperatives in Africa that can bring large pools of pre-qualified middle-class applicants to the mortgage market as a more viable avenue for attracting more affordable investment in the sector? So the role of housing cooperatives and cycles. Yes.
Yeah. Again, this is going back to the question, the issue that was raised before. Really, I think if the fact that it's a cooperative means that the members of the cooperative know each other well and feel a common bond for what they are, for what risk they're taking in funding housing for the members, and they can contain the risk in that way, so that they know that those members won't run from their obligation, as would any not unknown third-party private person. That obviously can reduce the cost because you're actually addressing the credit risk premium, which I spoke about. You're trying to reduce that premium because you're actually lending to those whom you trust and you don't have that problem with. In some countries, that I think has been tried. I think the impression I get from the SACCO kind of experiment and the microfinance type institution experiment in many countries in Africa is that common bond is very difficult to maintain, and it has to be a real focus of the institution and those institutions we're working with. So it doesn't mean because it's a SACCO it's going to work like that. You have to actually address this in a very specific environment, and you have to be, and that risk reduction isn't a given. So it requires a lot of effort and a specific kind of commitment, not only on the members but also on those managing the SACCO. So it can be made to work, and I think there are cases of microfinance banks, for example, in Nigeria, which I know quite well, where this does work and where this is making an impact on their viability. But it doesn't mean to say that that's true of many microfinance banks, and there are many hundreds of them in Nigeria. So it's the exception rather than the rule.
Thank you. We received another question from Lucio Frigo. Dissemination and rent-to-own schemes seems the more tangible ways via which the private sector can design housing finance products themselves. Which countries do you think provide the best legal macroeconomic context to enact this at the moment?
What kind of framework was it for what?
Indexation and rent-to-own schemes.
Indexation schemes.
Yes. And rent-to-own.
Yeah, the indexation schemes have been tried mostly in Latin America. That was because the high inflation rates in Latin American countries and the tendency to dollarize was so prevalent that to maintain some sort of local markets, there was a move towards trying indexation schemes. So if you want to look at that's probably it's countries in Latin America one needs to look at. The rent to own. Again, I think that in the paper you'll find the references. There is references to certain countries there, which I don't recall which countries we're referring to there, where that's been more prevalently used. That's kind of like the installment credit idea that you would, over time, you lease your property, and then over time you repay that on the property value, and it becomes yours later on. So yeah, and on the spur of the moment, I don't know exactly which country to refer that question to. Referring to the paper.
Thank you. And yes, I invite actually all the participants to go on the Center for Affordable Housing Finance website. The link is on the last slide, and you receive it when we will circulate the PowerPoint presentation at the end of the webinar. You find a full report that Michael produced and that we published last week, and you find much more information. We have time for one more question. If there is any question you'd like to ask one last question before we close. Okay, I think we are done for today. I want to thank Michael Fuchs for his presentation. I want to thank Fundo Mabasa for his comments and very interesting comments. Thanks to all the participants. Please do not forget to fill out the survey. We will share with you, like I mentioned, all the Michael presentation, Michael full report, and also the recording of the webinar. And thank you for your time, and I wish you all a pleasant day.